Good morning. Hope you're all doing well on Saturday. Probably another, if you're on the East Coast, hot, steamy Saturday morning. So today I got quite a few good questions the past couple of weeks, and I'm going to hit a couple of them today. I've got a couple that I'll do next time. And also, I am making some changes, going really, really short on the maturities or duration of bonds, a lot of T-bills and short-term, moving away from anything with mortgage-backed bonds, and essentially reconfiguring a little bit into a value international high dividend payer. I'll explain those a little bit more in detail next time. I was going to try to do it today, but the questions I got, I ended up working on those past couple of days, and then I had too many slides. So I try to keep these in an hour because I know it gets a little bit too long. So I'm just going to dig in a little bit on a couple questions. I still got a couple questions we'll do next time, which are dealing a little bit more with housing. And then we'll talk about more specific moves that I've made. Or we can chat at the end here, depending on what's going on. So let me just jump in. I'll share my screen. Okay. Today, a good question was, how does the Federal Reserve impact inflation? Was one of them. So I'm going to dig into that because you hear a lot about the Fed's fund rate and this and that, but we'll get into the actual dynamics of how their impact. I've been talking about recession for a while, and it's like, well, a few people ask, why haven't we entered that recession yet? What's going on? And why have the stocks not shown that we're entering recession? So we'll hit on those today. Again, it basically took up a lot of slides. So by the time I was looking at some other questions, I just didn't have enough. I don't have enough runway to get it done in an hour with any kind of detail. So the biggest thing you have to look at is looking at the government overall. What kind of effect do they have on the economy? How can they affect the economy? So, we're going to dig in a little bit on monetary stimulus today. So that's the Federal Reserve. So that's dealing with the actual underlying money that's out there. But the reality is there's also another big part that the government can do, and it's fiscal stimulus. So that's government spending. And we had just an unbelievable, massive amount of fiscal stimulus with COVID. So that plus the Fed being very accommodative on interest rates and monetary stimulus is what created this inflation. Okay, so that's what created it. Now, it's not just the Fed that affects the amount of money that's out in the economy or the amount of liquidity. There's really three factors. One is the Federal Reserve, which we'll dig into. The second are the banks themselves. We'll talk about this as well, but the banks actually create credit. They create liquidity. So it doesn't just have to be the Federal Reserve. The banks can do this too on their own. And then the third thing that can affect it is what we call the euro-dollar market. Now, I've talked about the euro-dollar market a while ago. It's probably 8-10 months ago. So it has nothing to do with Europe, it has nothing to do with euros, anything like that. This was because the US dollar is the world's reserve currency, and most countries will do all their business transactions with dollars. So even if Pakistan and Brazil are doing some trade, they're going to use US dollars. So there's always a demand for US dollars. And so what started to develop, I think it was in the 60s, was this off the US shores market for dollars. This euro dollar market began because a lot of entities didn't want to have to come within the United States banking system and all its regulations to get dollars. So there's a lot of regulations with it. So the euro dollar market is almost a bank in US dollars that's offshore and not subject to our banking regulations. And it's not as if, the Federal Reserve actually controls the US dollar, but this market does as well. It creates dollars. It's an accounting transaction more than anything. So if Pakistan and Brazil are going to transact business and they want US dollars, they can go to the euro dollar market. There's a ledger created. One of them is debited, one of them is credited, and it functions. So it can create a lot of liquidity if there's a lot of transactions happening in the international markets, or the fact that, basically if there's just a lot of demand for dollars, it can create a lot of liquidity through this avenue. And again, it was set up because they just didn't want to have to go within the United States shores and deal with the banking regulations. So famed economist Milton Friedman had a very good definition of inflation. In this quote, you've probably seen it on YouTube or anything like that if you've done any kind of query on money. But he said inflation is always and everywhere a monetary phenomenon, in the sense that it is and can be produced only by a more rapid increase in the quantity of money than in output. So what he was basically saying is that if the amount of money is increasing faster than GDP growth or economic growth, you're going to get inflation, pure and simple. And it's basic supply and demand. And we've talked about this before. If the supply of dollars increases, if all of a sudden there's just a massive amount of dollars out there, but there's still the same amount of goods and services that they haven't increased with it, you're going to get higher prices, right? There's more demand chasing the same supply of goods and services. So you've got more dollars chasing the same amount of goods and services. And what we really had during COVID was we had a supply shock. So the amount of goods and services was actually declining while the money supply was going way up, or demand going way up. So we had a really interesting situation with that. So, Milton Friedman always said that, a steady rate of monetary growth at a moderate level can provide a good framework under which a country can have little inflation and much growth. It will not produce perfect stability. It will not produce heaven on earth, but it can make an important contribution to a stable economic society. So, and everybody here knows, they've heard of Germany, Weimar Germany in the 20s. They printed so much money that, they had to pay their employees 2 or 3 times a day so they can go out and buy goods. If you just have too much money chasing the same amount of goods and services, you're going to have inflation. So how does the Federal Reserve actually affect the amount of money that's out there? Well, there's 3 basic ways that they do it. The first one is in what they call the banking reserve requirements. So the bank or the Federal Reserve tells the banks how much they need to keep of your deposits in reserves, also known as like in the vault. So think about it in the vault. How much do they need to keep on hand in their vault, and then how much can they lend out? So, usually the banking reserve requirement, typically since the Fed has been in power, has been about 10%. Now, right now, back in COVID in 2020, the Fed dropped that to 0%. So a bank didn't technically need to keep any of your deposit in the vault in case you came back to get some money. They can loan out 100% of what they have. Now, why is that a problem? And this also addresses why banks can also increase the monetary supply. It's called fractional reserve banking. So when you take your original $100 to your bank, you're going to deposit $100. Now, if the reserve requirement at the time is 10%, which is typical of what you usually see reserve requirements. Again, due to COVID, the Fed dropped that to 0%. But typically it's 10%. So what does that mean? It means the bank takes $10 or 10% of your $100, puts it in the vault, puts it in reserves, and they loan out the other 90%. So whoever gets this loan now has $90. And what are they going to do? Well, they're going to take it to their bank, deposit it. The bank is then required to set aside 10%, which in this case is $9. And then they can loan out the remaining 90%, which is $81. And this goes on and on and on again. And it does this to the point where, each bank might have 10% reserves, but we have essentially we've taken that $100 deposit of yours, and it has basically turned into $1,000 of banking liabilities, things that they've loaned out. So as you can probably imagine, it's essentially tenfold. So you have a lot of leverage in the banking system. And all the bank has to back it is 10%. So if for any reason that 10% is drained below zero, we've got a banking issue, don't we? And it could be, in the 30s, it was a run on the bank. So people would make a run on the bank, or even before the 30s. You make a run on the bank, the reserves are drawn, they're gone. But it could also be losses. So if a few of these loans go bad, completely or even partially, even if the loans lose 10%, that means we've lost the 10% reserves. So now the bank is going to lose dollar for dollar. And that's usually how these bank runs used to start. They heard some banks were losing money on some loans, and then the bank run would happen, and then you're done because you're so highly leveraged. When you're highly leveraged 10-1, it doesn't take much to create that kind of problem. Okay, so that's the first way, the reserve requirements. And still to this day, the Fed has a 0% reserve requirement. Fortunately, most banks aren't really operating that way, at least none that I've seen. So they're still using some prudence, but it is at 0%. The second way, and probably the most famous way, is the federal funds rate. So this is the interest rate that you always hear about what the Fed controls. And you'll hear this in the news all the time. And it is the most powerful factor because what the federal funds rate essentially is, it's the rate at which banks can get short-term loans from one another. So here again, going back to the reserve requirements, let's say one bank, maybe they have some loans go bad, maybe they've overlended, maybe they've had people come in and take a lot of the reserves out for whatever reason, not a run or anything, but just they're just low on cash. So they're going to borrow money from other banks or from the Fed in order to kind of build up their reserves or their cash balances. So they're going to pay whatever the federal funds rate is. So obviously, if the federal funds rate is high, that's going to pull liquidity out of the markets. That's going to pull money out of the markets. because the banks are paying more in interest to borrow money. And this is a chart just showing you, going back to the early 70s of what the federal funds rate has been. And you can really see the key thing to look at is from 2008 up until 2016, it was absolutely zero bound. And, so banks really had no friction when they tried to borrow money from one another. It was at 0%. Now, this creates a lot of what economists call malinvestment. You make stupid decisions with your money because you have such easy access to the money. Now, from about 2016, 2017 on until about 2020, the Fed started to raise rates once again. They started to pull their foot off the gas, pull some of the money that they had pumped into the economy out. But then COVID hit, they went right back to zero bound. And now starting to 2022, when inflation really reared its ugly head, they started to raise rates rapidly. And I always have said, like, the zero bound rate from 2008 until 2015 would have been a lot worse, but it really didn't get in the hands of consumers. So a lot of the Fed's actions that happened after 2008 were mostly to shore up the banks' balance sheets. So that money, while it did go into banks' coffers, it never necessarily made it to you and me so that we would take that money and go out and buy goods and services. And remember, if there's a lot more money, that means there's more demand for goods and services. And if the supply of those goods and services don't go up, then you have inflation. So we didn't have a lot of inflation despite being at zero bound rates from 08 until 2016, precisely because it wasn't getting into the hands of consumers. It was taking all those bad assets that the banks had from the mortgages and essentially taking those off and giving them fresh capital just to keep in their reserves. But with the recent uptick, obviously since COVID, that has created this inflation. So the Fed tries to control how much how much money is out there using the federal funds rate. So if they want to pull money, if they want to pull liquidity out, they're going to raise Fed funds rate, which they're doing now. So the Fed has not raised the reserve requirement. They haven't forced banks to change that at all, but they have raised their federal funds rate. And in fact, it's the most rapid increase in the federal funds rate that we've ever seen before. So the period from 22 to 23 has been more rapid than any other period that we've seen in recent history, going back to Paul Volcker in 1979. But so this is going to have a big impact because they're pulling money out very fast. They're really coming after it, and now we had inflation and kind of a booming economy when they threw all this money into the system. So what happens when they pull this money out of the system? Now, the third way that the Fed can affect the amount of liquidity or money in the economy is what they call their open market operations. So the Federal Reserve actually has an asset base of bonds. And when they want to put more money in the economy, they will buy bonds from banks and primary dealers and other big financial institutions. So they'll buy their bonds and give them fresh cash. So then that cash can be used in the economy. So that's another way you can stimulate the markets, the economy, everything like that. Now, this chart goes back to 2008, the beginning of it. Now, if I could take this chart back to 1950, and I've done it before in a previous presentation, that straight line you see around 08, 07, 08, until it really spikes up, that was really how it would look going back 4 decades before that. the Fed kept on its balance sheet about $800 billion, all in treasuries. So it was all treasuries and about $800 billion. They never really used their balance sheet to manipulate the monetary supply or affect the economy. So the Fed acted as like a bank you'd expect them to, very conservative. They preferred to use the reserve requirements, and then the federal funds rate was their big levers that they used. But in 2008, they had a problem because all these banks had these crappy assets on their books, all these, exotic mortgages that were really, if they weren't completely worthless, they were close to it. So what the Fed did for the first time ever is they not only would accept treasuries from banks and then give them clean cash, they started taking these other toxic assets. And furthermore, what they did is they priced it as if the assets hadn't lost a penny. So if the original mortgage loan a bank had was $500,000, but then due to the market conditions, it was now only worth, say, $250,000. Well, the bank or the Fed still gave the bank $500,000 in clean cash, but took that $250,000 mortgage off their books. So we had an absolute massive increase in the balance sheet of the Federal Reserve. And that continued on quite a ways up until 2014. So you got to see from 2014 to 2018 or so, it basically stayed about the same. And just like the Fed did with their overnight rate, their federal funds rate, starting in 2019, the Fed started to raise rates, but the Fed also started to reduce their assets on their books. They started reselling these securities. So what is reselling securities? So they sell it on the open market and they get the cash. So it pulls cash out of the market, out of the economy. So they're pulling liquidity out of the economy when they do that. And of course, COVID hit, and then they had just an unbelievable increase in the amount of assets that they bought at that point. You can just see, it's a parabolic straight up line. I thought the line from 2008 until 2014 was just massive, especially compared to having 4 or 5 decades before that with a flat line. But in 2020, it just was unbelievable how much money they pumped into the economy. Now you can see from 2022, even through today, they're starting to once again sell their assets on their books. They're putting these out into the economy, and then they're pulling the cash out of the economy. So they're basically drying up liquidity. Now you can see kind of a little spike there in 2022, just a quick jump up, and then it starts coming down. That quick jump up is when Signature Bank and First Republic were having problems. So the Fed stepped in temporarily to buy some of their assets. So that was a little spike up. But for the most part, they're pulling money out. So again, they're not doing anything with the bank reserve requirements. They haven't messed with that. But they're the other two levers that the Fed has, they're pulling on them pretty hard. They're starting to really reduce their balance sheet. This is another little chart to kind of give you an idea in the short term what's happening. It's certainly not reducing nearly as fast as they had increased it during COVID, but it is reducing. So it is pulling money out. And then, of course, the federal funds rate going up is going to pull more and more money out as well. So we have liquidity coming out of the market. I mentioned at the outset, there's 3 different ways that liquidity is affected. One is the Federal Reserve directly, 2 is banks, and 3 is the Eurodollar market. Well, the bank balance sheets are also starting to come down. Banks are not lending as much as they were. It could be due to Fed actions. It could be just more expensive to transact business with the federal funds rate going up as fast as it has. It could just be that they're a little nervous about the state of the consumer. If you look at, I think JP Morgan and Wells Fargo released earnings, and they're doing quite well on interest income because they're in a position where the Fed raising rates is helping them. But they're one of the few banks that can do that because they're a large institutional bank. But they are increasing their loan loss reserve. So they're putting money aside because they are starting to see more losses. Now, that's a good thing. It's a good thing that banks are acting responsibly here. So they're taking some money out and putting it into the rainy day fund because they expect a rainy day coming. But what that means is you have less lending. And when the banks are lending less, that's going to have an impact on liquidity in the markets. That's going to have impact on liquidity and cash in the economy. This is sort of misplaced. I meant to put this up earlier. It just shows real quick how the Fed's assets, the top line's the key one. Week to week, we're seeing a lowering of their total assets. So yeah, they're dropping it. And this isn't in million. Add 3 more zeros to the back of every one of these numbers here. So this is to give you an idea of how much it really is. Okay, so back to the banks. So the banks, this is just commercial real estate loans. And you can kind of see it goes back to 2022, starting in September. So from September to December, they were loaning, did a little bit more in December to March, but now there's just no lending for commercial real estate really going on, very, very little. And this is all, again, transacted in millions. So when you see $50,000 on the chart, that really throw 3 more zeros in there. So it's really drying up there. And I would suspect that it's going to stay at the levels that it's at now. Obviously, it's not going to go negative. They can't negatively lend money, but they could start to lose money on commercial real estate. If you also look at commercial and industrial loans, so this isn't commercial real estate. This is just all other loans that maybe you get as a business owner, as a manufacturing plant, things like that. And you can kind of see here that it is actually starting to go negative. So it was basically flat from December to March. And now they are reducing the amount of loans they're doing as far as for business loans and industrial loans. So that has an impact, a big impact on the economy. That's also pulling money out. And this is both commercial, this is all commercial debt. So this is going to be the real estate plus the commercial loans. And you can kind of just see the trend that's happening here. And it's starting to have an impact, all of this, on the money supply. And before I talk about this, I do want to throw out there, I mentioned, Federal Reserve banks in the euro dollar market. Now, the euro dollar market, it's very difficult to see how much is being transacted there. Because it's not really regulated at all, there's not as much information. But from people that I follow closely, they say that what they're kind of seeing in transactions is that's declining as well. As world economies are struggling, the demand for dollar there is slowing up, along with here in the United States. But you can now kind of see this is the M2 money supply. M2 money supply is basically all cash and cash equivalents. So it's actual hard physical cash, but it's all your bank accounts, your money markets, CDs, everything like that. So it's essentially what we would consider our money supply. You can kind of see the chart. And we talked about this before. In 2020, when COVID hit, the Federal Reserve, which has been in existence since 1913, they printed 25% of all the dollars they've ever printed in just that short 1 year period. So think about that. So from 1913 to 2020, And they did 25% of the dollars ever printed in 2020 in 1 year. So you can kind of see how that little bump is almost parabolic straight up. But you start to notice after 2022, all of these actions are starting to pull the money back out of the economy. And where the Fed is today, and with bank lending drying up like it is, I expect to see this continue quite a bit. And liquidity is the oil for the markets and the economy. So this is going to have a big impact overall. Now, the good news is the Fed is actually succeeding to a great extent on the inflation front because of this. So pulling all of this liquidity out of the economy is finally starting to curtail inflation. Now, we still have pretty good inflation. There's two numbers here. One of them is really hard to see, and I've got more charts on this here in a second. But the total inflation rate was only 3% for the month of June. Now, just a few months ago, about, I guess it was, what was it, May of last year or June? I can't remember the exact month, but we were at 9.6%. So now we're down to 3%. Now the goal for the Fed is 2%. So they still feel that they have to keep their foot off the accelerator and on the brake until they get down to that 2%. And the Fed Chairman Powell has said he is not going to do what Volcker did initially, or it wasn't Volcker, it was Arthur Burns in the 70s. So Arthur Burns was the head of the Fed in the 1970s. And what he did was he did initially curtail the mid 70s inflation that was happening as Ford was leaving the presidency and Carter was taking over. So they thought they had inflation controlled, but then they started bringing rates back down and inflation reared its ugly head again and really uncontrollably. So then Volcker came in and really put the hammer down on inflation by taking the Fed's fund rate up to 18%. So the Fed is haunted by that mistake of Arthur Burns. So they're going to not start to, at least they're not going to start to be accommodative and bring the rates down until either inflation is below that 2% rate that they want, or we do have some sort of serious recession that might prompt them to do it. So the overall rate is 3%. Now, the lighter line that's hard to see, and again, I apologize for it, it is what they call core CPI. So it's 4.8%. So it's still pretty high. That's the one the Fed really looks at because it's a lot of different items that affect the economy, affect people. The biggest one is rents and home prices. So, they look at these things, the core CPI, and they want that to be below 2%. That's really what they focus on. The press focused on the 3% figure, the Fed's looking at 4.8. So they still feel they have work to do to bring inflation back down. This is, again, showing you the total CPI. You can kind of see, okay, it was July 22, it was 8.5%. You can see what's been happening. So the effects of the banks starting to slow lending and the Fed doing their actions has had a positive impact on inflation. And this is the core CPI again. So it's still pretty sticky here. It never got as high as total CPI, but it's a slower moving calculation, which is why I think the Fed's going to stay tighter for longer than what we think. And what I argue the whole time is they're doing a nice job of checking inflation here, which is good, but pulling this much liquidity out of the economy is going to have a very, very negative effect. And it's going to have a negative effect eventually in the markets as well. So you get to like, why, if they've been doing this since early 2022, why haven't we seen a recession? A lot of the leading indicators I've been following have been dropping for quite some time. So I don't know exactly why the recession kind of hasn't manifested itself. And, a lot of people say, oh, well, it's not going to now, but I don't buy that, because I don't think that we're going to start to see liquidity improve in the very near future. We're going to continue to see money come out of the economy. But some reasons I think maybe we don't have a recession yet. And I kind of conglomerated this from other sources, but we remember there's monetary stimulus and fiscal stimulus. Fiscal comes straight from Congress and the president. So we actually had government transfer payments, mostly I think Social Security. It had a big 8% bump up in 2023. So pretty much everybody was getting any kind of government check, military retirements, things like that. Saw a nice little pay increase. So, maybe that's creating some liquidity in the markets, in the economy. The Inflation Reduction Act, despite the fact I've tried to find out like where this money's actually going, and I can't, like actual projects, but they've pumped in a ton of money with the Inflation Reduction Act. So that is stimulative to the economy. And we still have to run off. This is probably the biggest thing in my mind. We're still running off the largest stimulus ever. I probably should have put a slide in here for bank deposits. But if you saw bank deposits when they started doing the PPP loans, when they started doing those, $1,000 payments, the extended unemployment, all that stuff, everybody was pumping their money into the banks. And I said that at the time I was sitting on the board of a federal credit union. I've since stepped down, but we had all this money coming in, and they didn't really know what to do with it because it was stimulus. They weren't sure. Like, we don't want to make long-term loans with it because this could be very short-term. But yet, at that time, the Fed had taken rates back down to zero. So there wasn't a whole lot that we could invest in to make any money with it. So that has been being liquidated. So this stimulus is every month's been going down and down and down. And we're starting to see people who are on the lower end of the wealth realm in the US have really started to turn to things like, they have burned through their stimulus. They are now into heavy use of credit cards, installment loans, all that kind of stuff. And a lot of it was dumb decisions on their part. A lot of people went out and bought cars, and the car prices went way up, but people had this money and they were willing to pay whatever for the cars, and dumb decisions. But we're now at a point now that most of that stimulus is gone, but it has lingered longer than what we thought. When you put that much money into the economy in such a short period of time, it takes some time to get that out of there. The other thing this year, it's funny, I've got a cell phone that I get probably 2 messages a day, or at least I was, from different firms that could help me get my employee retention credit. So these firms take anywhere from 20 to 30% of whatever credit they can get you. But it's funny because I've talked to other clients who don't have a business and would not qualify for this retention credit. They're getting calls on their cell phone from these organizations too. And this has been about $83 billion just this year that they've given out to businesses again. This is in addition to the PPP loans. So this is on top of that. So that's probably one of them. And the last one is what they call the Fed discount window. This is a good graph of that. What's the Fed discount window? Well, this is where a bank can go to the Fed, hand them some assets, and get clean cash in return. usually when you're going to the discount window as a bank, you're kind of in trouble. Like it's sort of the last resort. So you can kind of see 08, obviously the discount window jumped quite a bit. And then during COVID, it jumped. Outside that, it was very negligible. Not a whole lot of use of the Fed discount window because it's a crisis lending facility. And 2022, it just skyrocketed even higher than it was in 08. And that, again, comes back to Signature Bank and Republic Bank. So when that little banking crisis happened, a lot of banks ran to the Fed. So, that could mean that there's more banks that are actually having problems and they haven't manifested themselves yet in the public. I don't know. I really don't. That's an enormous jump there. But it does provide some liquidity because the Fed's taking assets and what they're doing then is giving some cash. So now, again, we're talking right now, where's this recession that I've been talking about for 8 months or whatever. And, I look at different indicators and all of the indicators are a little bit different. They all tell you a little bit different story. But the biggest ones that I look at are what they call leading indicators. So these are things that typically happen before the economy rolls over. So that, they lead the economy, they lead it into recession and out of recession. And then you have what some call cyclical economic factors or coincident economic factors. That's the middle column. And then there's also lagging indicators. So those are the things you really don't see until pretty much we're into a recession. So they don't tell you a story until you get there. This third column I have here is aggregate economy. So it's kind of taking the leading, this coincident or cyclical and the lagging indicators together, putting them all together. I couldn't fit all four into one chart. But you can kind of see, looking at the leading indicators, it's still dropping rapidly. So, what are leading indicators? A lot of it is, looking at monetary policy is a big part of it. And then also future orders. Those are probably the two biggest things. So changes in monetary policy, changes in the interest rate, changes in new orders and changes in manufacturing orders. Those are the biggest parts of leading indicators. And they're all heading south and have been continuing to head south. And the rate of decline is accelerating. Now the coincident or cyclical indicators, they're still barely in positive territory at about 1%. So they're hanging in there. They are hanging in there. So what are those? Those are going to be manufacturing products that are finishing up, not like future orders for manufacturing. That's a leading indicator. But coincident, the actual manufacturing that is being done and delivered right now. It's also a big one is residential and commercial construction. That's a big one. But the thing is, the change in the cyclical factors or coincident factors it's dropping. The rate of decline is increasing. So while they have hung in there and really have been hanging in there for a few months, it's still on a downward trajectory, which kind of has me a little bit nervous. And then, the lagging indicators are always going to be employment, services, and then government spending. And if you take all of those together, and all the leading, all the coincident, all the lagging, you get the aggregate. And then you also throw in the aggregate non-farm payrolls, and then real personal incomes and real personal spending. So you take those factors to get the aggregate, and they're hanging in there. And I think the aggregate is hanging in there because of employment, which has been very strong. All The other biggest thing for, I guess, that kind of along with leading indicators, coincident indicators, is just the yield curve has been just a phenomenal tool to let you know, like, hey, there's some storms on the horizon. This chart just shows you from June of 22 to October 22, and then today of July of 23. And we now have the most inverted yield curve we've had in a long time, since the 70s. The short end of the yield curve is what the Fed controls. That's the federal funds rate. And that's what that little orange line that says Fed rate hikes kind of shows you. So that's what they've done since June of last year. They've taken that up quite a bit. And then you can see the long end of the bonds, longer end, 10-year, 20-year, 30-year. They also went up quite a bit from June of last year to the present day. So they jumped, from around basically 3%. Now they're up about 4%. And that hurt us as investors because I had money in some longer dated treasuries, hoping that would protect us from when the stock market was going down. And it didn't because of the situation with the Fed. But the yield curve it doesn't tell you you're in recession, but it warns you that one's coming. And it doesn't really actually come until the yield curve starts to flatten out. So it's either that the Fed starts dropping rates, mostly because either inflation's in check or we are in a recession and they finally see it, so they start dropping rates. Or it could just be the longer dated bonds continue to go up to match what the Fed is doing. And one of the questions I got was about bonds, which I'll talk about next time. Now, the other thing about inversions that I always look at is they also predict unemployment. So I've talked about how unemployment is keeping the aggregate indicators up about 1.5%, 2%. Employment's the biggest reason it's stayed there. And I don't really look at employment too much because it is generally a lagging indicator. But it can tell you quite a bit about what's coming up when you have this inversion. So the black line is when the 10-year treasury and 1-year treasuries invert. And then the orange line is the unemployment rate. So you can see when you actually get an inversion, unemployment isn't that bad at all. Unemployment is actually very low when you get these inversions. So if you go back to 88, if you go back to 2000, if you go back to 07, even if you go back to 2019, 2020, you can kind of see the black line going down, which means we're having an inversion. But unemployment, the orange, is also very low. But when that inversion switches back, when all of a sudden we lose the inversion, you also see unemployment go up, almost perfectly correlated with it. So it's probably really going to start getting bad once the inversion corrects itself. That's probably the biggest thing. And it might take a while because this inversion is so deep right now. It's the deepest we've ever seen. So jumping into the stock market, rising unemployment does eventually provide a headwind to stocks once we get there. So again, unemployment being a lagging indicator, you should see the market start to price it in before unemployment really starts going. And really, I think what this shows is that the market starts to recognize leading indicators or coincident indicators, and then unemployment comes after. But you see 6 months prior to a rise in unemployment, the market's sort of flat. 1 to 3 months before the rise, that's where you see the worst returns for the stock market. And then it's still kind of bad in months 4 to 6. But by the time we get to months 7 and 9, so we're 9 months into the unemployment, the market's pretty much turned around, and really the economy's turned around. So when you see the worst of unemployment numbers, that usually means that we're through the worst of the recession. But this gives a pretty interesting chart on unemployment right now. So what it's looking at is different factors of employment. So, the government, a lot of the services in government, education, and health services, they don't usually see cuts even during a recession. Doctors are going to be needed, teachers are going to be needed. We know government employees pretty much are going to have jobs. So that's been holding up pretty well. That's actually been increasing. And then you have two things: private non-cyclical and private cyclical. So private cyclical is kind of what you think. It's temp work, it's manufacturing, it's construction, things like that. Those are very cyclical. Those are already starting to almost go negative. And then private non-cyclical will be all other businesses out there that aren't either government, education, health, or cyclical. And it's holding there, but it is dropping. It is heading south. And this is a very busy chart. I apologize for this, but it takes basically those last three, the cyclical, non-cyclical, and total unemployment, and just kind of shows you. The red is cyclical, the blue is non-cyclical, and the black is all unemployment. Or I'm sorry, actually the black is non-cyclical, and then the blue is total unemployment. But you can kind of see during a recession, the non-cyclical really doesn't experience that big of a downturn. It did during COVID, only because that was just a weird situation. But for the most part, most of the unemployment is going to be in the cyclical areas, and then it drags down the total unemployment. So, manufacturing, construction, things along those lines, part-time workers, temp services, they really get hammered on unemployment when that happens. And right now you go to the far right of the chart where we're at 2023, you can kind of see, while they're still positive, but they have a downward slope. So, everybody keeps talking about strong employment, and it is low unemployment factor, which is good, but I don't know how long it'll happen. And the other thing that we've talked about in the past, and it seems to continue with the recent release of the jobs numbers last week, you see a lot more people, they're losing hours or they're being forced into part-time. So that kind of tells me that maybe businesses are struggling. You don't want to lay somebody off as an employer. A lot of people try to portray business owners and companies as cold-hearted, but they don't want to lay people off and disrupt their life like that. So right now, what you kind of are seeing is just, they're doing what they need to do to keep the employee, hoping that things turn around. So they're giving fewer hours, or there's been a lot of people that have been moved to part-time from full-time. And part of that too is also the boomers. There's a lot of boomers that are going part-time instead of full-time for personal reasons. Maybe they want to stay active, but they don't want to completely retire. So they're doing that. But, this is a trend that's sort of alarming. The other one that I watch quite frequently is the amount of withheld taxes. So this is something that is, the government can't really mess with this number. I can do a deep dive on unemployment numbers, and there's ways you could tweak it, just like company earnings. They tweak those. This one is pretty straightforward. It's all right. You got people working, and how much taxes are being withheld, and that kind of tells you a few things. It could tell you how many people have jobs, how many hours they're working. It could tell you how many part-time employees. So it gives you a very good understanding of what the actual labor force is looking like, and it's right up close to that, going negative. So they're dropping. So the amount of taxes that the government receiving are dropping. Now, they were affected a good chunk by COVID. So you see that spike up in 2020. So I don't know if it's more just a return to normalcy or if it's dropping, but for reasons that unemployment is going to start rearing its head, I don't know. But it's a chart to watch, and you can just see that we're not having as much withheld from our pay, which generally means that there's not as much pay going out there. How are we doing on time? I told you I was a little bit long. I'll try to wrap up here real quick. Now, the good thing for stocks, and I think that's why we're kind of seeing it here the past 5 months, is once the inflation starts to fade, it's actually been pretty good for the stock market. There's only been one period where it struggled, and that was 1947. Every other time we finally got inflation under control, stocks did well. So that is a total positive, and I think that's why we've seen that recently. And the big reason is the price to earnings rise as inflation falls. So again, we talked about price to earnings before. It's the price of all the companies of the S&P 500 or whatever index you're looking at divided by the earnings of all those companies. And there's three ways that the stock goes up. It either the fact that earnings are going up, or inflation's going up, or the price to earnings that people are willing to pay is going up. So those three factors kind of tell you what's happening to stocks. And so just the price to earnings, nothing else happening on the earnings side or inflation side. It's just alone that people are willing to pay more for the price to earnings, so that there's an expansion. So for instance, even from October of last year, the price to earnings based on forward earnings, so the next 12 months earnings, was at 20, and now it's up to 25. So stocks went up just based on that. The price to earnings expansion. It's not really anything fundamental to the stock themselves. It's just what people are willing to pay. And that happens when inflation falls. But the negative is eventually earnings start to drop as inflation fades. So that actually ends up hurting the earnings part of the stock. And then eventually, as the earnings go, the price to earnings tend to fall. And this is looking at inversions. So as this inversion in the credit markets, as that sort of rectifies itself and we get more normalized yield curve, PEs tend to fall quite a bit at that point. The only periods really that it hasn't, so far this one, but then 1989 it didn't, and then 2006 it didn't, but every other time it did considerably. Okay. We're right up to that hour. I always finish with my little disclaimer. If you're not a client, go get some advice, yada, yada. You can read the disclaimer on your own. So a lot to unpack there. Apologize, pumped in a lot. Let's see, any questions? So one question, it goes back to that chart showing the M2 money supply. Are they going to print new money at the 25% yearly rate? No, that was really just during the COVID spell. They put just a ton of money in at that point. We actually see the money supply now slowly decreasing. So they're starting to pull that money back. That's the process that's happening. And like I've tried to make my point here is that as this money comes out of the economy, it's going to have a negative impact on the economy. It's just how it is. If you're a small business trying to get a loan, if you're trying to buy commercial or residential real estate, it just gets tougher to do. And that takes a little time to manifest itself, but it does. It does. So. Okay, I think that's it. Okay, so I've hit the hour mark. Appreciate y'all stopping in. Again, this was all based on questions, and I've got a couple more questions I'm going to try to address the next time dealing with some real estate. Always get questions on real estate. And then we'll dig deeper into some of the moves I made. But I hope everybody has a great weekend. So take care.